Good morning, everybody. I'm going to ask you to start making your way to your seats, those of you who are not yet seated. Thanks very much. We're going to get things going a little bit early today because we have a wonderful presentation that might take a little bit more time than we're accustomed to. So welcome to those that may be just arriving and about to arrive, but as well as yourself. I want to, first of all, identify myself. I'm Keith Moen. I'm the Executive Director. It's my privilege and honor to serve in that capacity for you, for the NSBA. And I also want to acknowledge that we're gathered here on Treaty 6 territory in the traditional homeland of the Métis. The NSBA, a brief positioning statement about our organization. The NSBA is a completely independent and autonomous organization without affiliation to any other business group. We are unique and we belong to you, our members. We're large enough to get results, but small enough to make you feel at home. Throughout the NSBA's history, we've created something unique, our NSBA DNA, built on a foundation of business acumen and values which carry us into our bright future. Our mission is to create a prosperous business community through fearless advocacy that advances the causes of our members. The NSBA is agile, bold, and confident, and our vision is to be the go-to partner and place of belonging for every business. We hope these words resonate with you because they are more than just words, they are what we do. If you'd like to become more involved with the NSBA, please contact any of our amazing team here today. We also would like to take this time to thank PrairiesCan for sponsoring the Sustainability Series and the ESG program that we are offering here at the NSBA, which you'll hear about shortly from one of our esteemed colleagues, Dr. Anila Salman. We're also honored to welcome dignitaries from the First Nations representatives who are joining us here today. We have Chief Ron Bear and Angie Bear from Muscadet First Nation, and we have Conrad Bird from Atakakoop Cree Nation, and Irma Morasti from the Shoal Lake Cree Nation. Thank you and welcome to you all. We have a couple of announcements in terms of upcoming events. Our NSBA Network Series, which is our usually monthly breakfast and or luncheon events. We have a breakfast, it's a small business week breakfast event with BDC. It returns next week on October 21st at the Saskatchewan Club. Don't miss your chance to join us. And also, stay tuned for the announcement. We have our annual fireside chat with Mayor Cynthia Block upcoming in November as well, and rumors of a luncheon with Premier Mo coming up in the upcoming months as well, so stay tuned for details on that. Okay, so now we're going to have our lunch served. It's going to be via buffet, as you can see over there. TCU Place staff will let us know when it's your turn to go, and we'll reconvene in about 20 minutes or so. So thanks very much, and enjoy your lunch. All right, I know all of you are still, or most of you, I should say, are still enjoying your lunch, and please continue to do so. I also want to bring your attention to the lovely dessert tray over there, table over there, so don't let all that food go to waste. That's not good sustainability practice. You have to use it up, okay? So make sure you get your way over there while we're having the presentation going on. And while we're at it, how about a nice round of applause for TCU Place staff for the wonderful meal we just had. I love Greek salad, and that build your own Greek salad was outstanding, so thank you very much. Okay, so I am here briefly because I'm going to introduce Dr. Anila Salman, our Innovation and Sustainability Strategist. So Dr. Salman is a sustainability and innovation expert with 20 plus years of experience in public policy, ESG, and digital transformation. A Fulbright and Chevening Scholar, she holds advanced degrees from both the University at Albany and the London School of Economics. At the NSBA, she leads projects that help businesses integrate sustainable practices and navigate ESG and digital shifts. Anila's global perspective, passion for the community, and commitment to mentoring shape her holistic approach to building resilient, future-ready organizations. Please join me in welcoming Dr. Anila Salman.
Thank you, Keith. Good afternoon, everyone. It's wonderful to see all of you for our second session of the Sustainability Series. When we at NSBA started this initiative about 8 months ago, that's when I joined, our goal was simple and ambitious: to help Saskatchewan businesses understand what sustainability really means for them. Not as paperwork or optics, but as smart, practical ways to build stronger and more resilient businesses for the future. Because the truth is, sustainability is no longer a distant concept or an abstract idea. It's becoming the new language of opportunity, and it's shaping how supply chains operate, how investors make decisions, and how customers choose who to trust. Now, the big part of this conversation is about our carbon footprint, where our emissions come from, and how we manage them. Businesses today need to know the 3 scopes of emission. Scope 1, as many would know, is what we make, the direct emissions. Scope 2, what we buy, the indirect ones. And Scope 3, the supply chain, what moves through our value chain. At NSBA, we know that it might sound a bit complicated, but that's exactly why we are here to help you. And we'll soon be launching a carbon calculator on our new website to make it easier for Saskatchewan businesses to measure and start reducing their carbon footprint. Now, the thing is, most large companies like Nutrien already report on Scope 1 and Scope 2, but the world is now also turning attention to Scope 3, the broader supply chain. And that's where our local businesses come in. And the question is, what do suppliers need to do to prepare? And how do they align with these evolving expectations? And that's why today's discussion is so timely. We're talking about how to scale sustainability, how a global leader like Nutrien is raising the bar, and how that leadership opens doors for the local and Saskatchewan businesses right here at home. And our 2 speakers bring that connection to life. Janice Anderson is the Senior Director of Technical Accounting and Sustainability Reporting at Nutrien, and is also a member of the Canadian Sustainability Standards Board, helping shape companies across Canada report and stand behind their sustainability performance. With more than 2 decades of experience translating complex data into meaningful accountability, Janice understands that integrity in data gives credibility to every sustainability claim. She brings not just expertise, but vision. And that's what impressed me when I first talked to her, reminding us that sustainability isn't only about reporting results, it's about reimagining what results mean. And our second speaker, Matthew Salins, is the Nutrien's Director of Environmental Sustainability and Performance. He leads the team that turns high-level commitments into measurable, real-world impact through water stewardship, emission reduction, and operational excellence. Matthew's work reminds us that sustainability doesn't live in reports and strategies alone. It builds, day by day, through systems and decisions and people who make that change tangible. And together, they represent both the strategic and the practical side of moving from vision to action, from global leadership to local opportunity. Please join me in welcoming Janice Anderson and Matthew Salins to the stage.
Back right here? Excellent. Hi. Wow, this is a great crowd. It's really nice to be here. What a welcoming opportunity to share our story at Nutrien.
No, it's great to be here, and thank you for the excellent lunch. We're going to need to get through this before my stomach catches up with my brain and I go for a nap.
All right, so thank you for the kind introduction. I think we'll give a little bit more about your backgrounds because I do think we are experts in our fields. Why are we here today? Just to give you a little bit more of a background into us. So I am Janice Anderson, and I lead the technical accounting team, which is like, why do we recognize revenue and embedded derivatives? And then I also lead the sustainability reporting team. And that really is just the synergies that we're starting to see with finance and sustainability reporting coming together. But before Nutrien, I've been at Nutrien for 5 years, but I spent 5 years at the Alberta Securities Commission, and I was a securities lawyer, or working in the securities regulation space, and I was building some of the regulations that our Canadian companies apply today. So my love is standard setting and securities regulation, making me super fun at parties. And so because of my technical accounting and securities law, that's how I got into the Canadian Sustainability Standards Board. And we're going to talk a little bit about those standards today to help kind of shape your sustainability story.
And I'm Matt Salins. I'm the Director of Environmental Sustainability Performance with Nutrien. A little bit of background. I've been in agriculture my entire life. I grew up on a farm. I have a Bachelor of Science in Agriculture. I worked at an ag retailer in my early days, also for a large chemical company. I spent many years working for a TD Bank, helping them build their agricultural portfolio within their commercial division. And for the last 21 years, I've been with Nutrien in a variety of roles, from corporate business development and strategy, working on mergers, acquisitions, and research, to treasury, marketing, energy and raw materials procurement, Lean Six Sigma, process improvement, planning and forecasting, transportation distribution, and for the last several years, I've been in the environmental and sustainability space.
Which is to say, Matt has done certainly a lot more than I have
Can't hold
at
down a job.
Nutrien.
I know a lot of you are probably familiar with Nutrien being in Saskatoon, but I thought we'd just go through a quick little overview. Nutrien is one of the world's largest fertilizer producers with many production facilities, 6 potash facilities here in Saskatchewan. We have 13 nitrogen facilities located in North America and Trinidad and Tobago. We also have a handful or a half dozen locations to produce phosphate fertilizer as well, including 2 mines. We are also the world's largest agricultural retailer, interacting with over 600,000 growers through a network of almost 2,000 locations, 1,300 of which or so are in North America, another 400 in Australia, and roughly 200 in South America. And we do this through over 25,000 employees.
I will also mention that the slide deck has been provided or will be provided, so you can definitely take pictures of this. We did get it vetted by our comms team, so that's great. So yeah, please just listen in to this presentation. I also want to give a disclaimer. So these are our views and our thoughts, and especially when it gets into conversations such as greenwashing, please do not take our advice for legal advice. And then we just hope that you guys are listening and understanding, but here's our actual disclaimer on our presentation. So Matt, what are we going to speak about today?
Well, actually, we're going to start off just a little bit of background, the evolution and history on sustainability reporting and climate reporting. We'll get into the topic, new topic that some of you might be familiar with called greenwashing. And then we'll eventually round out talking about sustainability strategy, target setting, and value chain engagement.
Yeah, hopefully what we're hoping to is just really weave this story in. You know, how did we get here? How does the sustainability reporting kind of function work? And then how should you actually set strategies and try to weave in some of the advice that we have learned over the past 3 to 5 to 20 years of being in sustainability. So I'm going to kick things off and talk about my bread and butter, which is sustainability reporting. And let's first talk about voluntary reporting. So how do we typically communicate as companies with our stakeholders and predominantly our investors? So before, if we go back around 5 years ago, before this proliferation of sustainability reporting, we communicated in, I would say, 3 main documents for our public companies. We'd have our annual report. This is our financial statements. And then we would talk about what our financial statements results were through our management's discussion and analysis. We also have the middle one is the annual information form. So for public companies, this gives you an idea of what the company's history has been over the past 5 years, some of the key information about that company, but it also has a really big discussion about a company's risks. It's written very legalese, kind of a boring document to read. If you're a mining company, that was also where you're going to find the reserve information about that company. And then the third document, we have our management information circular or management proxy. And this document is a regulated document that talks about our governance structure, who's on our board of directors, what are those committees, and gives really pertinent information when you're voting for whether you should keep with the board's governance structure or not. So this is our traditional communication mechanisms. And these have been built not only under securities law that mandates all of these disclosures, it's also been built upon a reporting framework. So do I have accountants in the room? Who are my accounting friends? Yay, accounting. Okay, great. So most of you, we use a framework when we're doing our financial statements. If you're a Canadian public entity, you're using the framework called International Financial Reporting Standards, or IFRS. Certain companies can use US GAAP if they're listed in the United States, and private companies can use what we call as ASPE, or our private sector accounting standards. I'm seeing a lot of nods, so I'm resonating. To produce this information, we must follow a framework. We must follow the rules. What is an asset? What is a liability? How do you recognize revenue? This is my technical accounting side. But there is also rules on disclosure. How much you should disclose. Is your disclosure complete, accurate, verifiable, and understandable? So now let's contrast this with our sustainability report. So I'm going to talk about the history of sustainability reporting. But currently in Canada, we do not have mandatory sustainability reporting, nor are we. That rule has been put on pause, and I'll talk about that in our section on mandatory reporting. So right now in our Canadian context, we don't have rules that mandate what you put in a sustainability report. So these are voluntary disclosures. Companies can pick and choose what they report, how they report, the amount of information that are in these reported documents. Now, they are public-facing documents. They are covered under the realm of securities laws. But the securities law says, do not mislead. So your bar is pretty high, like don't commit fraud, don't lie in a public document. But there's no rules that are mandating how much or how little information, or even what metrics you should be putting in this document. So when we look at these reports, I would say these reports are long. Has anybody read a sustainability report? Like you're looking and you're like, I don't love reading them. They're very long documents. I think on average we're finding sustainability reports being about 100 pages long. This year, Shell's document was 481 pages with 330,000 words. Like, I'm sorry, but I'm not reading that, and I can't imagine all of Shell's investors reading that and actually finding it decision useful. So how did we get to this place? What it really started was, and I'm going to, again, what we're talking about, I'm going to take you guys a couple years back, but it was this investor hypothesis that really started to change how companies reported and sustainability reporting. And if I go back to a PwC Global Investor Survey from 2022, they really talked about, well, investors say they see sustainability as a priority for companies. And we really started to observe this in the marketplace. So not only in the past have investors historically cared about earnings, cash flow, and they still do. Don't get me wrong, investors want to see earnings and cash flows. But we also started to see this demand for more information about longer term views. How do you create long-term value? How is your operations not eroding value when you're thinking about some of these risks? And also, have you thought about other forms of capital? Have you thought about human capital? Have you thought about nature capital? And do you have unhidden risks in your business that you potentially aren't managing? So really, when we take a step back, investors are starting to demand more and more information about sustainability, but also through this lens of what risks are you not managing? And we think about it in a way that when you're thinking about a typical enterprise risk management or strategy, these are really focused on a shorter term time frame. So a business is setting out a strategy, we do 5-year planning, and then it's annually revised, but you're really looking at this window of 3 to 5 years. But some of these risks that we're going to talk about from a sustainability lens are actually 5, 10, 20, 30, 50 years out. And so the hypothesis that investors were saying is, are you understanding your risks beyond your current cycle? What are the longer term risks that you should be thinking about, and should you do anything today about them? And a lot of this has to do with the climate risks. And Matt is going to take us a little bit through the climate related and what types of climate risks you should be thinking about. But this is where the investors were coming from, to say, are you thinking about long-term value creation given these changing environments? And is there something in that environment that could erode your value and could erode future earnings? So when you have investors starting to demand more and more information, this became the proliferation of ESG reporting frameworks. And I don't know if you're familiar with some of these. Has anyone heard of the TCFD? Okay, I'm saying it's a task force on climate-related disclosure. Who started the TCFD? Does anybody know? Mark Carney. Mark Carney was the originator of the Task Force on Climate-Related Financial Disclosures. This is not a political speech, by the way. I come from Alberta, so I have my own political views, but interestingly enough, he really was the pioneer of sustainability reporting. And our current sustainability standards right now actually follow the TCFD framework, which I'll walk you through. But as a company and as a preparer, you're being asked, okay, you should prepare some ESG information. You're like, great. How do I do that? Then these frameworks started to merge, and everyone thought there's different ways to talk about sustainability for different stakeholders with a different lens. So you're inundated with all these different frameworks to follow. So as investors started to take note of sustainability, guess who also started to take note of sustainability? Well, if investors care about sustainability and the information and are starting to use this information to make investment decisions, this is where the securities regulators step in, my former employers. So in Canada, we have the CSA. This is the umbrella organization of the provincial securities regulators. They were actually the very first regulator in the world to come out and propose, I'll say propose, mandatory reporting on climate. Now, then right after that, in 2022, we had the US Securities and Exchange Commission also propose mandatory climate reporting. And in fact, their rule was 490 pages of proposed regulations. The final regulation was 800 pages of regulation to report on climate. Now what happened? We had a change in government in the US. And so the Democrats were really the ones pushing forward with their climate change rules. And the second that Trump came into power with the Republicans, it was immediately canceled. So right now it's still kind of going through the litigation court, but the litigation or the rule itself is stayed. And so there is no more mandatory reporting in the US, I would say, for the foreseeable future. Because of our connected capital markets, the Canadian regulators followed suit. So if we think about the way capital flow works in Canada, we can't have securities regulations that are harsher, more burdensome than our American counterparts. People just won't list in Canada. And that's a critical risk for our Canadian capital markets. We want companies to go public. We want them to use our Canadian capital markets and not the US market. So really the Canadians' hand were kind of forced on this one, so they have now paused their rule. So in terms of mandatory reporting, we're not in an environment in Canada that we will have mandatory reporting anytime soon. That said, our current securities rules say if you have a financially material risk, you need to already report on it in your documents. And I would say for the most part, our Canadian public companies are really already reporting on their climate risks, scope 1, scope 2, maybe not yet scope 3. But there's already this rule of mandatory reporting, but not at the granularity originally proposed. However, we also have the EU going strong on mandatory sustainability reporting. I'm not really going to touch in, but if you guys have any EU operations, they are certainly going full speed ahead with a lot of regulations that may even impact Canadian public companies. There's a current change and it's called an omnibus, so we're kind of waiting to see what happens, whether Canadian companies will be impacted. So when we looked at all of the voluntary frameworks, everyone kind of said, well, there has to be a better way. We can't have all of these 20 reporting frameworks out there. Could there possibly be an organization that takes them and consolidates them into one framework? And that answer is yes. So the same people who came up with the IFRS accounting standards put up their hand. They said, we're pretty good at creating accounting standards. I think we should give a shot at doing sustainability standards. And so that's where we have the IFRS sustainability standards that have now come out, and they've been a consolidation of the TCFD. We also have SASB industry standards. So all really the message is that frameworks are starting to consolidate, and we're now starting to have, we call a global baseline of sustainability disclosure standards that are the IFRS sustainability standards. Now, we still have GRI. This is the Global Reporting Initiative. This has been around for about 20 years. They're very European-centric. They still exist. And then we now have the ESRSs because we love our acronyms in sustainability. These are the European Sustainability Reporting Standards. If you're caught under EU rules, you also have to follow those standards. I will point out there's two differences, and Anila kind of mentioned this, but there's starting to be different frameworks, and picking a framework is so important to understanding why you are reporting to who and whom are you reporting to. I would say if you want to talk to investors and you only want to talk about financially material topics, this is where the IFRS sustainability standards come into play. And we'll get into what those means because I believe in these standards. I mean, I sit on the board of the CSSB, but it really is only about what is financially material to a company. But however, you're like, hey, Janice, I want to talk more, not just to investors, but I also want to consider my impact on communities and have a broader sense of materiality. That's where the GRI and the ESRSs would come in. They're a broader stakeholder focus, and that's when we'd use what we call a double materiality. So my knowledge today is there's a lot of frameworks out there, but they're starting to become this global baseline emerging. And let's talk a little bit more about how this fits into the Canadian sustainability standards. So in Canada, we have a Canadian Accounting Board, an Assurance Board, and now we have a Sustainability Standards Board that I was one of the inaugural members. How we adopt standards in Canada is we actually are generally adopt the international components, which is why Canadian public companies apply IFRS, the International Financial Reporting Standards. Same with our auditing standards. Our auditing standards, we take the international and bring them to Canada. So sustainability standards are no different. So the Canadian Sustainability Standards Board was set up to bring these IFRS sustainability standards for Canada. So if you're going to look at the standards, they look the exact same because they are. I would say the only difference is that our standards has allowed a little more time to transition to some of the harder concepts. So for example, if you want to disclose scope 3, we've given you 3 years of transitional relief and said, okay, it probably will take you, if you want to embark on a journey to calculate scope 3, it'll probably take you about 3 years to actually get a calculation that you want to put in the public market space. So that's just kind of the lens of what framework, if you're looking at following a framework. And again, because we're not in a mandatory reporting framework, the CSA, I would say, has been very, very favorable for our standards. And they say, look, if you want to report for Canadian companies, use the Canadian sustainability standards. So for me, it would be my starting point to try to understand what you're reporting.
So that's a lot. How would you summarize all of that into why do we need standards?
You guys didn't catch my key message? So why do we need standards? I think, my view is we need standards that set consistent, comparable, decision-useful information. Stop the madness of these 100 to 300 to 481-page documents. Really take a step back and why are you reporting what you're reporting? What are your financially material risks and opportunities? And only talk about those. Matt and I know because we work very closely on some of the information, but ESG rating agencies have asked us just amazing questions. Like, how much wood are you burning in Brazil to create those emissions? I'm like, nobody cares. It's not financially material information. So that's really what the structure of these standards are. So the standards really kind of take you through this way about how to report what is financially material. So what it gets you to think about is what are your sustainability related risks and opportunities? And then if you think about those risks, will you actually pay money for those risks in the future? In your short, medium, and long term. So will it actually cost real dollars, either through increased insurance costs, increased maintenance costs? Maybe if you look at your forecasts anymore and you have to predict that you're going to have a hurricane once a year and your operations will shut down. Those have real dollars associated. And when you start to look at your risks, you're not trying to capture all the risks. You're not trying to say, well, the icebergs are melting, polar bears might be dying. That doesn't have a risk to your business. It might have a risk if you're maybe there's a polar bear company in here. I should not assume. But what you're doing is you're looking at what are the risks that actually affect your company. And what's also unique about these standards is they also say, okay, well, you might have a risk, you might not have a risk in your operation, but does your upstream suppliers have a climate-related risk? What if all of a sudden they're highly exposed to climate risks, they go out of business, now you no longer have an upstream supplier. Now that's going to have a trickle-down effect on your business. Let's talk about your downstream customers. What if your downstream customers no longer want to purchase your product because let's say maybe it has a high carbon intensity associated with it. Now you no longer have suppliers buying from you. You either have to find a new market for your product or that product line is gone. Have you thought about this? And then what is your strategy to mitigate from that risk? So these are a little snapshot of the standards and what it's going to get to talk to you. Once you identify your risk, you're like, but Janice, what do I talk about? Talk about 4 key things. What's your governance, strategy, risk management, and metrics and targets? And this is actually the TCFD framework that Mark Carney came up with. But all it says is, okay, you've now identified a risk. First of all, what is that risk? And then have you set a strategy to manage that risk? Okay, if you've set a strategy to manage a risk, what is your governance structure to actually make sure that you can actually take actions against that strategy? What is the board engagement? What's management's engagement? Tell us about the governance around this. And if you've set a strategy, do you have a target? How do you know when that strategy has been made? Do you have a target? The standards don't require targets. If you've set a target, how are you tracking success? Have you set metrics that you're going to regularly report on? And that's the framework. What is your risks? What is your strategy? What is your governance? And what is your metrics and targets?
So how would you define sustainability, Janice?
So obviously that's teed up as a question, but that's a hot button. The standards actually never defined the term sustainability because it's too hard to come up with one universal definition of what is sustainability. And I like to think about sustainability in terms of just a time scale. And maybe I'm thinking about the 7 generations concept, but if I think about my business and is my business sustainable, will it still be in operations in 100 years? And if it's not, what's going to cause my business not to operate in 100 years? And that's kind of the lens, like to be a sustainable company, we have to pay attention to the climate risks. We have to pay attention to our human capital risks. If we don't focus on enhancing our workforce safety, we might not have people to work in our business to have a business. So when you start to think about it from that lens, that's one way to think about how you start to define sustainability, understanding those risks and then putting dollar values to help understand, is that a financially material risk? What I also have on the slide is, as I said, the IFRS Foundation, or CSSB, has incorporated what we call the SASB industry standards. Those are also a great place to start looking to understand, like, well, for an industry, do we already have industry metrics that we should probably start to look at and collect, and are those relevant? So here are some of the mining ones, for example. Mining standard would say you should probably report on your waste and hazardous material. Greenhouse gas emissions is a given, but what about your air pollutants? And maybe your tailings produced and waste rock generated. Those are probably some of the key metrics. If you're investing in a mining company, you want to make sure you're understanding that they're managing. And so before I pass the mic on to Matt to talk about climate reporting, I did again want to really reiterate common mandatory reporting for Canadian jurisdictions. I've highlighted on this a bit, but right now Canada had a climate rule. It is on pause. Probably years, not months. If anyone's like, whew, didn't have mandatory reporting, what it means is it gives us more time as companies to prepare. This is on our timeline now versus being mandated by the government. The government is really saying, if you have these risks, if investors are demanding this information, you can report it, but it's not mandated. And I think that's really helpful for the smaller to mid-sized companies, especially those thinking of becoming public, because to start this work will cost money, to measure your emissions, to think about your risk. It's not a $0 amount. And I think the regulators really appreciated that it would cost and it'd be burdensome to our smaller to mid-sized public companies to implement this securities law. California, Mexico, and Australia, and the European Union, I highlight these is because these have all issued mandatory reporting effective for 2025, released in 2026. And it's not just for those companies listed in these jurisdictions. These also have extraterritorial rules that you might be captured if you have operations. So for example, if you only have operations in California and $1 billion in revenue in the US, which we do, you are captured under California state rules. So this is kind of one of those things with sustainability. It's really crossing the lines between, should this be a securities regulator issue and only regulating where your shares are listed? And now it's also where you're operating. So if you're operating in any of jurisdictions, Australia in particular too, you might have mandatory reporting. So Matt, I've talked for quite a bit. Let's take us through climate reporting.
Oh, and thank you for that comprehensive overview. And I think you get an appreciation, and you probably already do, that sustainability and reporting is much broader than just climate. There's several other aspects that were just on the previous slide. But what we want to do is to actually dig into the climate reporting side. It is the one that investors have been asking for information on the longest. It's the most developed. And for those of you that might just be starting out, we wanted to give you a little bit of an overview on that. So where do you start with your sustainability reporting? And Janice had already mentioned that you probably want to look at your different types of risks is a good place to start. And there are, under the different frameworks, 2 different types of risk. One of them is the physical risk side, which there are 2 types within this as well. There's the event-driven things called the acute risks, storms, flooding, winds, hurricanes. So there's all those types of event-driven items, and then there's also the longer-term or more chronic types of risks that you can have. And I'll use an example in this case. Pretend you have an asset, it's your best performing asset, and it happens to be on a tropical island somewhere. It's getting cold outside, I think we can go somewhere warm. So you have this, and it happens to be your best performing asset in your portfolio. And it's on the coast, and it's subject to sea levels rising, and also subject to more frequent storms. Well, we can actually start to quantify those things, because in the short term, you're like, well, we have incremental maintenance costs. We also have incremental insurance costs. Medium term, you have more maintenance costs potentially, and higher insurance costs. And then longer term, if the water gets too high, you could actually lose that particular asset, in which case you might have to take an impairment on that asset. Now, you can ask yourself, to the investors, is that important? It's like, well, you just told us it's your most important asset, and it's going to have incremental costs, potentially lost revenue, and you might have to shut it down at some point in the future. It's probably a material risk that you actually want to disclose. In addition to physical risk, there happens to be this thing called transition risk. And this is in a world where all the governments get together and they agree, and we all align and meet the 1.5 degree Paris target number.
Accord. Well, definitely. That'll definitely happen, right?
Yeah,
we can all agree as governments.
Exactly. So in this particular situation, what do we have? Well, how do governments do this? Regulations, taxes. So, there's a world where we'll end up paying more and more for our taxes. We'll pay on every single ton of CO2 we emit. Additional regulatory burden, and so forth. So these are 2 types of risks to actually start to evaluate where you should be reporting your risk. You can also look at, Janice had already mentioned, there's many different frameworks you can start to look at your risks. In addition to that, maybe your company has your own internal enterprise risk management group where they're already studying risks. Maybe you have a group that is studying risk, but it could be augmented with some of these sustainability topics. Another good place to start is actually going and asking some of your key stakeholders about what's important to them and why. And if you really wanted to get into the weeds, you could actually, going back to my Lean Six Sigma days, you could look at your entire business as a process, starting with your suppliers, ending with your customers, and then, the 5-6 steps in between that represent your business, and then asking, what are the key inputs and outputs to that business, and then evaluating. And you want to screen them because you might end up with hundreds of them. And to ask, in terms of severity and frequency that they happen, is this actually potentially material to me? So that's a good way to start thinking about risks. Now, when we get to the reporting side, there's obviously the IFRS, and within those standards, you have customers really, or investors really want to know, what is the resilience of your business? What are your climate risks? What is your strategy? How are you going to mitigate or not mitigate those risks? Have you set a target? How much is that target going to cost to achieve? What is the progress against those targets? And those are some of the things required in IFRS. But when we get to climate, one of the things, similar to the IFRS financial side of things, we look at, net income, adjusted EBITDA, free cash flow.
I've trained him well.
As I also have an MBA, but yes, Janice has trained me well. And in terms of that's how we measure the financial success of our companies, the size, the durability of those organizations. Similarly, we use greenhouse gas emissions as a proxy or a way of measuring what our climate risk is. The more emissions you have, you potentially have more exposure to climate change. And one of the things is to actually provide guidance on how to measure those things. Some of you I've heard, are already reporting. So you're probably familiar with the greenhouse gas protocol. And yes, while there's other frameworks out there, this is the one that is the clear winner, and the vast majority of companies are actually using to figure out what their scope 1 and 2 and 3 risks are. And Anil already mentioned that there are scopes 1, 2, and 3. Here's a nice pretty picture in terms of those. Obviously, as already mentioned, scope 1 are all of the direct emissions that come from your operations you control. Us as Nutrien, our largest source of scope 1 emissions happens to be in our nitrogen fertilizer manufacturing business, where we burn natural gas for heat, and then we use that heat to crack other natural gas molecules to release the hydrogen, which we make ammonia with, and then ammonia is the building block for all other nitrogen products. And in terms of scope 1 emissions, we generate roughly 10 million tons of scope 1 emissions a year. Scope 2 is all the purchased energy that you get. A lot of it for us is electricity. We also get steam. You could also buy cooling from other people. And if you think about electricity, a lot of us get it from the grid. Here in Saskatchewan, the grid is roughly 80% from fossil fuels, roughly 50% based on recent studies from natural gas, another 30% roughly from coal, and the remainder is from renewables. Now, what we would do is we would use a grid factor, which is an emissions factor. And this based off of the mixture of your fuel sources. And you would then multiply that by your electrical consumption, your gigawatts of energy that you're consuming. Then, as mentioned, there's the scope 3. Scope 3 is everything else upstream and downstream of your operation. There are 15 categories. And of those 15 categories, not all of them may actually be applicable to your organization. And one of the an example for us, our scope 3 emissions, this is just a graphic with no numbers on it, but we already talked about how Nutrien is one of the world's largest fertilizer manufacturers. You'll see that show up in our natural gas consumption, which is all the upstream emissions from getting us the natural gas. But our largest categories happen to be related to our direct-to-grower retail business. And in that, we purchase a lot of fertilizers. We don't just produce ours, we purchase a lot from other suppliers. We also purchase a lot of chemicals, and you'll see those as some of our upstream sources of emissions. But by far, our largest emissions category happens to be our on-farm use of nitrogen fertilizer. And this is through a natural microbial process. There's nitrogen in the soil. There's also nitrogen that we apply, obviously, as fertilizer. And microbes break down a portion of that into a nitrous oxide in the form of N2O. It gets released to the atmosphere. And because N2O is 273 times more effective at insulating the globe than carbon dioxide, a small amount has a very large impact. Now, where do you start reporting your scope 3 emissions? You'll note here that you don't see 15 boxes. Some of them are lumped together. Some of them are completely excluded. And the reason for that is a good place to start is with a relevance assessment. The GHG protocol provides you some guidelines for how to do a relevance assessment. It has 7 categories. You can use them however you see fit. You can weight them differently. You can exclude certain metrics. But it's all about figuring out what is the most important thing you actually want to report on.
Tiers?
Oh, yes, thank you.
You're welcome.
In terms of tiers, within Scope 3, there are tiers 1, 2, and 3. Tier 1 is the least granular. It's the easiest to do. It's typically taking your revenue or spend and multiplied by a global, national, regional emissions factor. I say it's simple and easy to do. It does take some time and effort. Tier 2 gets a little more granular, where you start to shift from dollars as the activity basis to actually volumetric things or other measures of activity, multiplied by more specific emissions factors. And then Scope 3 actually gets into, for an example, is our on-farm emissions. That's where we have like a geospatial model where you will use different layers from soil type to climate to weather, including precipitation, to the type of fertilizer we applied, and multiplying that down to like soil grids can get very, very small into the meters. And to move between those different tiers, just for us to move from tier 1 to tier 2, to put the grand scheme in perspective, we moved from gigabytes of data, and I mentioned a geospatial model, to tens of terabytes of data. It's a massive lift. We also do tier 3, which we'll talk about very much later but that's for within our sustainable ag team in our retail operations that I'll talk about a bit later.
Yeah, I think the point, and maybe coming from the Canadian Sustainability Standards Board, because we did say that Scope 3 is a mandatory disclosure and we gave 3 years transitional relief. I think the point that we're trying to illustrate is it may be complicated, particularly if you're going to those tier 2 and tier 3 calculations. I think the world is getting better at understanding your Scope 3. You're not really going down to the invoices. You can make estimates. It's an estimate upon an estimate upon an estimate. They're starting to become resources. But just kind of keep that in mind, that there's going to be different tiers and levels, and it just determines whether you're going to set a target. Because if you're setting a target, you're going to want that granular information because you want to actually show actions will reduce your emissions, versus when you're not setting a target and you're only doing it for reporting purposes, maybe a tier 1 calculation is just fine. When I talked with investors at the Sustainability Standards Board who were really pushing for Scope 3, and I'm like, why do you need it? Why is this an interesting number to you? And they said, well, Janice, it's about understanding your risk. And do you understand, at least have a sense of where your Scope 3 emissions are coming from? Do you know what your upstream suppliers' emissions are? Do you know your downstream customers? And what is your exposure to climate change? So they're using it as a way to understand risk, which is why I say if you're only looking at it from a pure reporting standpoint as a risk base, tier 1 calculation is just fine. And I would push back on those saying, well, you need a Scope 3 target, and I want to say why. What is going to be meaningful that? And so it's starting those conversations, but Scope 3 is really good proxy to understand risk in your value chain.
Yes, and that level of granularity, and not just what you want to do with that information. As I said, there's the reporting side, but then if you want to set a target, you likely want to get to a little more granular level, because the only way to reduce your emissions, if you only have a tier 1, is to reduce your revenue. Probably not something we want to do.
People don't really like that.
It'll also impact based on your data availability. And you don't have to choose a tier 1, 2, or 3 across all the categories you're going to report. You can pick and choose. For this category, it's the most meaningful. I want to set a target. I want to get a little more granular, but for this one, it's tier 1 is good enough. So it can be a little bit mix and match. And even within that tier, you can have a mixture of, like in our purchases, we have more granular information on fertilizer and chemicals, but there's a whole other category. We don't necessarily drill into the weeds on the other category.
Yeah. So that brings us to our next topic before strategy setting, and we want to talk about greenwashing first. And I think this is really relevant because now that we've gone through the scopes of emissions, I think it's important when we talk about greenwashing and one of those terms, net zero. And when you're talking about, I'm going to net zero, that actually does mean you're going net zero for your Scope 1, Scope 2, and your Scope 3. Words matter. We've seen some companies go, oh, when I set a net zero target, that was only on my Scope 1. I'm like, well, you might really want to clarify that. So it's really even setting those targets, and when you're saying net zero, it's understanding what you mean, because we have new greenwashing regulations out there. So greenwashing is the use of misleading or unsubstantiated claims about the sustainability or environmental attributes of a product or services. And we joke a lot about this, but who is inundated with the word green, sustainable, low carbon? Like, what does that even mean? Like, I was staying at the hotel in Saskatchewan, they're like, most sustainable operations. You're like, okay. Put my jeans on the other day. My jeans literally had a green tag on it. It says made from sustainable material. And you're like, what does that mean? These have been used against us as marketing materials and gimmicks, when actually what you're finding is these companies aren't as green or sustainable because there's no definition of what is sustainability. And so the regulators and the Competition Bureau have taken notice about it. I'll talk first about our Canadian securities regulators, because if you're doing a report, you are covered in this regulations. It's a public-facing document. So under Canadian Securities Administrations, they came out with their first view of what greenwashing is, And if you are greenwashing, it's also called overly promotional disclosure. Again, you have these slides, but I do recommend, if you want to think about this one, there is a staff notice called 51364, Google November 2022, and it's their CSA notice, and it talks about regular reporting issues. Greenwashing is around page 17. This is just how my mind works. And what it really does is take you through a couple examples of public companies that have been found guilty of greenwashing and what not to do. So I think the CSA has been very helpful there. What you should be more scared about is the amendments to the Competition Act under Bill C-59. Who knows about this bill? Oh, more people should have hands up. Okay, so what happened? The Competition Bureau, their act was amended on June 20th, 2024. It received royal assent, and it is now effective as of 2025. What this is the Competition Bureau typically was used for between companies. So let's say Matt's running a company and I think he's doing something anti-competitive. Me as company B could go and make a Competition Bureau complaint. So what Bill C-59 is changed who could make complaints to start a greenwashing investigation. Any private citizen can now make a complaint, and by private citizens we mean NGO activists. So you only need 6 to make a complaint to the Competition Bureau. The worst part about it is they added a reverse onus clause. So as a private citizen, I could go, hey man, I think this company is greenwashing. What the reverse onus means is that I don't have to prove how that company is greenwashing. They have to prove how they did not greenwash. How do you prove you did not greenwash? There's 2 things. You have to say that you have done adequate and proper testing of your claim under a recognized international methodology. And then the Competition Bureau did not define what any of that means. So even over the course of the year, we're like, is the Greenhouse Gas Protocol an internationally recognized methodology? Are the Canadian Sustainability Standards, if you use that framework, is that an internationally recognized methodology? I think at the CSSB, this is why this is not legal advice, would say, well, if you follow a standard to produce reporting, if you're following the greenhouse gas, this should mitigate your risk, but it's not proven in a court of law. Now, if you're found in breach of this act, how much is it? What are you going to have to pay? The answer is up to 3% of global revenues. I don't know about you, but I'm pretty risk adverse as an accountant, so I am now very careful. Every word we put out into the public space is like, did you follow Bill C-59? Like, is this an internationally recognized methodology? So it's making sure we're really trying to mitigate this risk. Now, the Competition Bureau did give some advice. So again, if you're making claims like this is green, this is sustainable, you're going to want to make sure you've thought about this. Have you done adequate and proper substantive testing under an internationally recognized methodology? So I want you to avoid exaggeration, avoid blanket claims. I would say I'll give you an actual example, and I know this is being recorded, so I can't really say Chatham House rules, but a couple of years ago, there was a document that we were going to put out in public, and it was like, environmentally sustaining mining practices. And you're like, oh man, we are mining potash from the ground. Do you think someone might say that that's not environmentally friendly? Maybe we shouldn't use those words. And so actually then we dug into it more with the team, like, why did you say that? They're like, well, actually we're using more energy efficient mining vehicles to mine. You're like, that's fantastic. Those are the words that we're going to use. So again, it's avoiding these just sustainable and green and net zero. So use words that mean something to help combat greenwashing. So if we scared you enough with this, now let's get into sustainability strategies and target setting.
Well, thank you, Janice. When we're thinking about sustainability and strategy, maybe a good place to start is back to what is the definition of sustainability?
Nobody knows.
Nobody knows. But before we even get into that, I think maybe we'll spend a little bit of time on the evolution of sustainability. We borrowed this from Gardner, and it's what they refer to as the hype cycle associated with sustainability. And I really like some of the words across the bottom, from innovation to the peak of...
it's the peak of inflated expectations.
And then trough of disillusionment. These are fantastic.
I heard we have a laser pointer, so we are here. We're in the slope of enlightenment, getting to the plateau of productivity. So we're on the upswing, guys.
And this is where it's the we are here. That's more of a generic point of the broader society. Each company may be at a different point upon this particular curve, but what we're seeing is really a move from this idealism to pragmatism, from trying to do everything to being very targeted on what actually is meaningful to our business. and basically, yeah, taking and moving to action. So with just a little bit of background, should you set a target? And anyway, so how do we think about sustainability? And it comes back to that definition. And your definition of sustainability might be different for every single company in this particular room. And some of the ways to actually think about it is, are you addressing what your material risks of your organization are? And how have you gone through to determine what those risks are? And some great places to start, we already talked about some of the frameworks that are out there that you can follow. Mentioned already that you can maybe reach out to some of your key stakeholders and ask them what's meaningful to them and why is often a good question to ask. And then you could also, I already walked through a bit of a process that you can actually think about starting just looking at your business from beginning to end and understanding where are your key risks and how is that related to a sustainability aspect. Now, in terms of strategy, I've seen lots of bad strategies, and I've read lots of books as well. But one thing that has always stuck with me, because it's very simple, and anybody that knows me has heard my soapbox speech, so it's great to have a new audience. But in terms of any good strategy, number one, you need to actually have a goal. We want to be the best, the fast, the most efficient, the top tier, whatever your goal happens to be, you need to have a goal. Number two, define what the scope of that goal is. Because if you try to do said goal across everything, it's going to be very frustrating. So we want to achieve it in this geography, in this product line, in this business unit, whatever it happens to be, but define that scope. Number three, you need to have some sort of competitive advantage. What is going to allow you to achieve said goal in said scope? And without some sort of advantage, whether it's people, processes, systems, there's a variety of things that can give you a competitive advantage. But when you have those three things, the fourth thing seems very obvious when I say it. Logic. How do those first three things make sense together? Anyways, so there's a little bit of preamble on sustainability and strategy, and we also included the definition that the UN came up with in 1987 here, which is meeting the needs of the present without compromising the ability of future generations to meet their own needs. Now you might want to get a little more specific, and when we think about your own business, it's much broader than just climate. I've heard that in some pre-discussions beforehand. I've also said it as well. Sustainability as an organization, it's not just environmental sustainability, you also need to be profitable. Thinking about Janice, 7 generations of the 100 years, you need that to be profitable, you need to be able to maintain your assets, you need people to work for you, despite what they say about AI. You also need robust communities for those people to live in. So there's lots of different things that will impact your sustainability, and how you define it has to suit you. And what I'll get into the strategy as well, when you're thinking about strategy, there are different ways of setting it. You can have a separate sustainability strategy, but if you do have a separate sustainability strategy from your corporate strategy, it should at least augment or support your corporate strategy. Best case scenario, it's actually integrated into your corporate strategy. So there's a bit of a spectrum because they're very different. You may find that there's some friction within your own organization. When we're thinking about the different types and where you are in the organization, who owns it is important. Is it a single executive? Is it a committee? Where in the organization does it sit? I already mentioned standalone versus integrated into the corporate strategy. If you are just starting out on your journey, if you think about a startup company, as several of you may have started up your own companies before, you may actually want to set it up as a separate function so that it actually gets the attention it needs and support, in which case it'll likely need some seed money, which may cause some friction with other parts of the business. But as you mature through this, you might actually see that transition from being a standalone function to being integrated into your business's DNA.
All right, covered that one. Let's get into a case study.
Yes, so we're going to jump from that into target setting. I know Janice and I could talk about these things all day, and we do. So we're trying to keep this down to an hour. And if it's one of the themes that comes through the discussions we've been having is before you set a target, you have to start with the question, why? What are you trying to achieve with this particular target? Are you trying to address a core risk? Are you trying to demonstrate progress in a particular meaningful area of your business? But start off with the why. Once you have the why, it's good to have a governance structure, starting with, do you have an executive sponsor or executive support? Do you have a mandate to do this? What we found really helped for us is actually having a project document and actually a project charter. And then we actually described exactly what we're going to do and what time frame we were going to do it in. And we walked that around and met with key stakeholders. And before we did that, we actually did a stakeholder assessment to try and figure out who was going to be supportive and who was not going to be supportive, so you could actually customize your messaging. And then, it's good to actually understand what your governance review process is, which leads into the constraints. When we started out for this water, we said, well, we have a year and a half, that's fine. And then when you looked at it, it's like, well, based on the review process, we have 6 months. So 6 months really changed our perspective of how we were going to approach this project. And having guiding principles, if you have them, they can be quite useful. We did not at this particular juncture, not officially written down ones, but there is some intuitive ones, such as, well, any of the projects going to the greenwashing needs to be properly funded. Like, we are not going to commit to a target unless we actually have a viable pathway to achieve it, which is one of the other bullets on this particular slide. You can take different approaches. You could have a top-down versus bottom-up. How many people have been in corporate and set a target and then tried to push it on operations? And how did that go? Or likewise, have you been in operations and actually received some objective that corporate has given you and said, what were they thinking? Likewise, if you're in corporate and you've asked the operating businesses to actually come up with a target, was it ambitious enough? So what we found really worked for us was actually bringing in subject matter experts from not just several corporate functions, but also subject matter experts from our operating facilities themselves. And that comes down to the internal engagement, which was critical for the success of this particular project. What we found really helpful, going to the governance structure again, is actually having an advisory panel, which we were children when we came up with this because it's the water tap, target advisory panel. Yeah, yes, pun intended. Not enough laughs, but anyways, it's funny in my head. So this advisory panel happened to be the senior vice presidents of the 3 operating segments that we were engaging with, which meant that we had support. We had resources at the sites we were engaging with, through the GMs all the way down to the operations individuals. And we went for approval on this. I didn't have to say a word. The 3 vice presidents presented it and defended it to the executives. So that we found very, very beneficial. And to use another pun, you can't boil the ocean, at least we're trying, but it's good to actually define your scope and boundary of your project and how did we assess where we were going to focus our efforts. We started off with, where could we have some potential risk associated with water use? And what we did is we used actually an international, it's a tool available online, and it actually identifies the high-risk watersheds globally. And then we plotted our facilities on that and just said, okay, which facilities happen to sit in a higher risk watershed? One caveat in learning is those tools tend to be fairly generic. And yes, they have specific looking maps, but it's good to actually go and get local context from your facility, because some locations that happen to sit in higher risk watersheds didn't actually get water from that watershed, and thus we scoped them out. Another thing we looked at is where can we have the largest impact in our business? Because you don't want to, if you're going to do something, you want to go somewhere where you can actually drive change. So if you take those 2 aspects, and you can throw in a variety of others as we did, you end up with a 2x2 matrix. I like those. And then we drew a line through that to determine which sites are we going to engage with, and that's how we ended up getting our subject matter experts and support for those projects. I already talked about making sure you have a reasonable pathway to get there. When we started out, I mentioned we only had a 6-month time frame. We weren't sure we were going to be able to set a numerical target. So we actually started on plan B. And the plan B was, what are the things that we could do to show progress and attention to water that would be meaningful to an external reader or an investor or so forth. So we actually started on 2 paths. Thankfully, we were able to set a numerical target. And you'll see our target written here on the very right-hand side, which you've already probably read, which we, happy to say that we actually achieved a year early in 2024.
So that was the thing. And to put in perspective, we set out a target to cumulatively, that's a really hard word today, to reduce freshwater use by 30 million cubic metric tons, which I believe we quantified as like, what is it, 20 or 30 seconds of Niagara Falls running, you tell?
Oh yeah, so it's the equivalent, so 3 million cubic meters of water is 1,200 Olympic swimming pools, standard depth. And then there's, or it's the, for those that have stood at Niagara Falls and watched it, it's the equivalent of 20 minutes of flow over the falls.
20 minutes. I was like, 20 seconds seems small. 20 minutes of
20
flow
minutes
of
of
Niagara
flow over
Falls.
Niagara Falls is what 3 million cubic meters is the equivalent to.
And it started with this project, and we didn't try to say we're going to reduce our water by 1%, but we're going to have targeted action.
And part of the reason we went down that path as well is this important footnote. Describes how we do that. It's based off of specific projects. We didn't do the generic approach, and part of our challenge is because of the area that we cover, especially some of our phosphate mines, like some of them are 100,000 acres. So in places that rain a lot, and the variability in precipitation can swing our numbers by up to like 50 million cubic meters of water per year. So for us to go and set a percentage target, just the variation in the normal consumption and handling of water would skew those numbers. So we focused specifically on what was the outcome of those projects and were we able to sustain those projects.
Okay.
Perfect.
I was like,
one last point I'll make on there is direct versus indirect projects. There are obviously water projects in there that were done specifically for water. Examples here at our potash facilities. There's a location we incorporated brine water into our particulate emission scrubbers instead of using fresh water. Likewise, at one facility, we also installed variable rate flow technology into those scrubbers. So depending on how hard we were firing the dryer, we didn't have to use as much water if we were firing on low versus firing on high. But then there are also projects that are not directly related to water. And where I'm going with this is look for projects where there's mutual benefit, because it's much easier to get projects approved if you have several benefits that fall out of it. An example, at a phosphate facility, we had several pumps where the seals were getting to end of life. And I'm not an engineer, so I may get this wrong, but they had gland seals in the pumps, which needed a continuous flow of water. And when we went to replace them, we had a choice between replacing in kind or replacing with mechanical seals. We actually ended up going with mechanical seals, which has the benefit of not needing water. So look for those mutual benefits and never stop looking, which is how we got to the target early. We kept looking and working with the sites to find new projects.
okay, we'll cover this last topic and then
In
we'll get to
3 minutes.
Q&A. We can do it.
Perfect. I'll just talk faster. When you're thinking about supplier and value chain engagement, I'm not going to get into the details, but it's a common theme throughout. Why? What are you trying to accomplish? Given the interest of time, I won't go through all these things, but are you trying to address a key risk for your stakeholders? Are you trying to meet a regulatory requirement? For us, we're shipping into the EU for some of our products. It falls under the Carbon Border Adjustment Mechanism. We now need to get supplier information to calculate our own footprint of the products we're selling into Europe. Fun. Now, who should you engage with? Again, it's very difficult to try and tackle everything all at once. And yes, there are some companies that are going to reach out and discuss this with all of they want to reach out to every single one of their suppliers. I'll talk about how they can do that in a minute. But if you're just starting out, you probably want to focus on where can you have the largest impact. So don't, instead of the hundreds or thousands of suppliers or value chain partners you have, shorten that list to a critical few. Have a proof of concept, show that you can get results, and then move forward from there as necessary. And the other thing to look for is it's good to go where you're wanted. So if there are people in your supply chain or value chain that are reaching out to you on these topics, those might be people you want to engage with, because it's much easier if you have a common objective which leads into the strategy. It's good to also have some overlap in what you're trying to achieve in your strategy, because if there's a disconnect, it can lead to some problems. How should you engage is also quite important. I would recommend having a single person if you're reaching out to customers, you probably want to engage through sales so that you don't have multiple people reaching out to the same individual or the organization through multiple channels, because that can lead to confusion. For some of these, we work directly with sales, and some of them we work directly with our procurement group to engage with those suppliers. I mentioned if you're trying to engage a very broad set, there are service providers out there. That's how some companies are reaching out to 100% of their suppliers, because they recognize that it's time consuming and they can't do it alone. But you don't need to start there. And there's other examples of how you can engage here as well. Do you call them? Do you send them a survey? Do you build it into your T's and C's? We've actually received contracts where some of our customers are building in rules into their terms and conditions.
I would say, though, also as a company, look at those terms and conditions and don't blindly sign them. What are you committed to?
Yes.
And making sure that you're not in a contractual negotiation standpoint if you can't meet those targets.
Yeah, absolutely. And then just to bring this home into some examples of what we've achieved and done in this space, recognize the importance of community. We've set out to improve the engagement with the Indigenous groups, and also lean into and recognize the importance of economic reconciliation. And then to that end, we actually set a 25 by 25, which was to achieve a 25% Indigenous impact spend by 2025. And through that program, we've actually achieved $1.1 billion of Indigenous impact spend since we started the program in, I believe, 2020. And since then, we've actually enhanced that program, and we've gone from just binary questions to a more holistic approach, and we've already started incorporating Indigenous questions into our request for proposal processes, so when we're reaching out to engage with suppliers. I mentioned that our on-farm emissions is our largest source of Scope 3 emissions. We are actually engaging with our sustainability, our ag sustainability team, to reach out to consumer products goods companies, protocol developers, and a variety of other stakeholders to leverage our 4,000 crop advisors and agronomists, and to measure and improve outcomes on the field, Tier 3. We have also engaged with on this TF5 which is the Fertilizer Institute, to develop the Verified Ammonia Carbon Intensity Program, where we worked with peers to actually develop a methodology to measure emissions of our nitrogen products, and to also how do we get them certified, so that to build transparency and confidence within the industry. With that, I'll hand it off for the 30-second wrap-up.
Yeah, I put in some slides. I thought it would be helpful to you guys to peruse at your own view. It's just some of the keys to the success that we've had. I also put in what does a reporting journey look like, so you guys can take those away and review. If you were inspired by this presentation to learn more and do more and start your own reporting journey, we added some couple slides on that. But final thoughts, know your why, know your audience, why are you doing what you're doing, to set a reporting strategy, and then also to set a strategy on targets and metrics if you want to pursue. So hopefully we've peppered in some of our learnings over the past couple of years. It has been challenging to work through it, but as you can see, we're really achieving a lot of the targets that we set out to go. So with that, I think we have a bit of 10 minutes for Q&A, but thank you very much for your time today.
Wow, thank you, Janice and Matt. This was incredibly insightful, and we might have to call you again. There's so much to unpack, and thank you so much for making, carbon accounting and even sustainability sound so much fun. Thank you. So for questions, if you have any questions, there's a mic over there, and so the house is open.
Hello, thank you for your presentation. So my organization would be considered a Scope 3 provider, and what we do, quick shameless plug here, we do workplace technology. We've thought about our value chain and our ESG impacts, but we would only come into play during a refresh cycle of, let's say, 5 years. And what I'm getting at here is the granularity and difficulty of measuring your scope 3. And I wasn't even going to talk about this, but you mentioned AI at one point, and it concerns me because AI has such a intensive energy usage, but is also possibly the most difficult to quantify. That, like, number one, people are running random queries at work, but also AI is integrated into so many different business applications and technologies now. So I'm just curious on your thoughts about measuring that.
In terms of the emissions from AI or the use of AI to measure emissions?
Well, I guess you would have to quantify it, right? And then how do you quantify how much being used to how much emissions it's producing? I don't know, by query, by... I think it's an existential question, but I'm just curious as your thoughts.
Can I take the accounting side and test my thoughts on this one? So if I'm using AI as a company, is it just more electricity? No, it would be more the data cloudy. So it would fall under your scope 3. Like I was like, we can measure the electricity as scope 2. This is why this is a fascinating industry. You're right.
And the interesting part about that is it's not just the electricity in our own computers, but it'd also be the electricity being used in all of those data centers to process that.
Yeah.
And it's a great question for how do you actually measure the impact from that usage?
It's so ambiguous, right?
It's so ambiguous.
But plus it's, I just did a quick Google before the question that in 2022, it was using 2% of global power production. In 2026, it's projected to be 4% of global power production, and it's only going to increase as companies rush to AI. So there's a big environmental impact, I think, but a very ambiguous way to where is it being used and how are you quantifying that in your business?
Well, we were talking about that from a Microsoft perspective, just even looking at Microsoft's own emissions. So Microsoft has set really aggressive targets on to reduce their scope 1 and scope 2. And if you look at their actual, it just keeps going up and they're like, well, we're doing AI. And I'm like, well, I think that's being disingenuous. So I agree. There's going to be different ways to measure things, and scope 3 is supposed to capture your upstream and downstream value chain, and maybe we take that away for a consulting question, because I agree. That's why scope 3 is challenging, and you set estimates and you describe why you have these estimates.
Yes, and there's also not just the electricity use, but then there's also the massive water consumption associated with the AI facilities that's used for cooling.
Did you want to get a microphone?
Could we get the microphone to this gentleman?
Did you want?
Chief?
Thank you. Very good presentation, lots of information. Just from an investor's point of view, when you talk about sustainability and about going into the future, is there a target for the longevity of a company like Nutrien?
Well, actually, that's a really good question.
Did you say that's a really good question and point it to me?
That's a really good question for Janice. No, I can start and you can jump in. But yes, when you're looking at sustainability, you can use scenario analysis, and it's something you can do in-house. There's also consulting firms that will charge you a bunch of money to do it. But when you look at typically you look at like a 5, 10, 30-year time frame, and you look at scenarios, well, there's a world where the governments that I mentioned, where the government step in and we have regulations and we hold to the 1.5 degrees. There's a world where that doesn't happen, that it continues to expand. And then you can look over the 5, 10, 30-year time frame. And the objective of the scenario analysis isn't to predict the future, but it's to prepare for a range of potential outcomes and for investors to be able to understand how prepared are you for that range of outcomes.
Yeah. We continue to get a number of investor questions. I'd say questions on climate and nature and social. Those continue to be a relevant investor topic. I would say if you go back 5 years ago, that's all the investors were talking about. So you have seen the pendulum shift a little bit, but we're taking a lot of investor calls because they want to understand what are your risks, what are your opportunities, do you know your business? So it is very prevalent, I'd say, from an investor lens to keep, and that's why we keep getting to do sustainability reporting, measurement, and keep getting to do it because investors care. Did that answer your question? Did we take it in 2 different ways?
No, I think that answer is pretty good. Thank you very much. Appreciate that.
We might have time for one more question.
Thank you for making the trip out from Cowtown and gracing us with your presence, Janice and Matt, so thank you. Just coming back to the S-curve, and I'm so glad that came up, and looking at, a lot of the smaller and medium-sized businesses in the room, Nutrien's been on their sustainability journey for, over a decade now, and companies now and organizations have the opportunity to potentially learn from the pitfalls of others, going through that, hype stage, right? Where can you go wrong? So just want to maybe hear a couple other points of, for the smaller companies in the room where they can kind of jump in and learn from kind of the, kind of the experiences that you've had.
I think we really tried to weave our experience in without being so negative on our experiences, but some of the trials and tribulations, trying to set more prescriptive targets with actionable measures and capital, getting the buy-in. Really, like what we found really worked well was setting those cross-functional teams to make sure that we understood each other, and it turned into like legal, audit, risk, environmental measurement in the strategy. So it's kind of, that's what we kept saying, like, why are you doing this? Like, what's meaningful? Is it investor driven? Because our investors are asking, how are you reducing your emissions? What are you thinking about nature? Are you reducing your water? We're like, great, we're gonna focus on there. Because it might not be like, if we look at the scope of sustainability, safety is a key, safety issue. If we weren't focused on safety, our investors will come knocking, but we're managing safety really well. But it's these risks that are a little bit broader that they're saying, well, you haven't talked a lot about climate, can you tell us and set those targets? So that's how we really focused our strategy. So from a small, medium-sized business, I'd start with, what are your customers asking you? Are your customers saying, hey, what are your scope 1 emissions? That might be your starting point. Measure those emissions. Hey, do you have climate physical risks? What if there's a wildfire? I think if we think about, the Canadian environment, are you susceptible to floods, not hurricanes, floods, fires, forest fires? Do you have contingency plans? How are you going to be able to get insurance? What are those risks? So I'd start to think about, like, what are the real, first of all, short-term and medium-term tangible risks? Are you managing those? I think that's where we're saying, like, as a small, medium-sized company, to start thinking about, do you need to put focus into those areas to manage those risks?
I think a great place to start is first recognizing that you cannot do everything.
That's fair.
If you go in with that mindset first, and it's like, okay, I have limited resources, where am I going to focus my efforts? And to Janice's point, what are your customers asking? What are your primary investors asking? What core risks have you identified as your organization? And start there with something small.
Like if I go back to where Nutrien was, and if you read our ESG report from a couple of years ago, you'd see we had like 27, 28 targets. And I remember joining kind of this ESG compliance team to get us ready for mandatory reporting. And I remember one of our targets was to put, 25% or 25% of women in director and above roles by 2025. And it was around 2021, 2022 at this time. And the metric was 20%. So we had 5% to go. But then I did math. And that meant like we'd have to fire 100 men and hire 100 women into those roles. And I went down to HR and I was like, hey, how are we planning on meeting these targets? So are we firing the men? Like, can I start applying for jobs? And they're like, what target? And I was like, right. So that's why we wove into the conversation when it was like, if corporate's just setting targets to sound great, that's probably not going to be effective strategy. And so I think that's one of also the learnings too, is that making sure everyone is buying into these targets and not setting targets because it's cool, setting targets because it's really core to your strategy and where you want to set your time, effort, and resources.
Bring operations along.
Bring operations along.
Thank you so much for all this energy, for answering the questions. We would love to go on, but we know we have a flight to catch.
We do.
So I'll invite Keith for the closing comments.
Thank you, Anila, and Janice and Matt. That was outstanding. Thank you so much. But I do want to just put a plug in for Anila and her hard work in getting this event off, and thanking you very much for coming out from Calgary, as was already mentioned. But for those of you that want to go down this path, that's what Anila's role is to help you get where you want to go. And she's so perfect for the role because her mandate is she'll meet you where you are and take you where you want to go. So she's very thoughtful and pragmatic about this approach, and not the militant thou shalt, which we knew wouldn't work within our demographic of our membership. So please do reach out to Anila when you have the time. Finally, I'm just looking for I don't think I have any other notes other than to say we have gifts for Janice and Matthew.
Thank you.
And here they are.
You guys have been great. Thank you for letting us talk and share our stories, by the way. So, okay. I know. Thank you.
Awesome.
Oh,
Thank you
my
very
goodness.
much.
Okay. Thank you so much. Okay.
All right, and that wraps up. Thanks for your patience, everybody. We'll see you soon. Take care.
Do you want to do a picture before we?